As we all prepare for the presentation of the Union Budget by Finance Minister Shrimati Nirmala Sitharaman tomorrow, there is an important document that is released one day prior to the Union Budget. Do you know what it is? It is the Economic Survey, usually released on January 31st every year, but since this was an election year, it will be released today on 22nd July, a day before the announcement of the full-fledged Union Budget. But what exactly is the Economic Survey? The Economic Survey is an annual report card of the country's financial performance in the preceding fiscal year. It is prepared by the Finance Ministry's Department of Economic Affairs under the guidance of the Chief Economic Advisor. Basically, it's a document that assesses the state of the economy and provides an overview of its short-term to medium-term prospects. So why should you care about it? Let's break it down into three exciting parts. Before the Union Budget, the Economic Survey gives us a clear picture of how the economy has been performing. It summarizes the government's work, major programs and policy changes over the past year. The survey is split into two parts. Part A looks at the overall economic developments and challenges we faced. Part B focuses on specific areas like social security, poverty, education, healthcare and the environment. In this video, we will focus on Part A and talk about the 5 things you should know as an investor and the roadmap for the country. So without wasting any more time, let's get into the Economic Survey 2023-2024. We all know that the Indian economy is performing remarkably in comparison to other countries, with India's GDP growing at 8.2% in fiscal year 24, making it the fastest growing economy in the world. According to the report, India's economy is expected to grow at a rate of 6.5 to 7% in the current financial year, which ends in March 2025. This is more of a conservative outlook since the projection is lower than the 7.2% forecast by the Reserve Bank of India and the 8.2% growth achieved in the previous year. If you look at the image on the screen, global rating agencies have also revised their estimates ranging from 6.6% to 8%. Despite uncertain global economic performance and a growth rate expected to be at 3.3% in 2025, India is well positioned to again be one of the fastest growing major economies. Now let's talk about an indicator that has caused havoc not just in India but also globally. After a long fight with inflation which was caused by several factors like the pandemic, geopolitical tensions and supply chain disruptions, inflation in India is within the upper band of RBI's tolerance limit. However, the fight is not over yet since the ideal target remains at 4%, and in fiscal year 24, India witnessed inflation at 5.4%. Adverse weather conditions have been impacting food costs, leading to further inflationary pressures. If you see the image on the screen, while inflation declined in the last few months, it rose to a 4-month high in June to 5.08%. The report suggests that inflation could hover around 4.5% in fiscal year 25 and 4.1% in fiscal year 26, assuming normal monsoon and no external or policy shocks. Coming to the bit that will interest all the investors. The Economic Survey 2024 highlighted a significant increase in retail investors. It noted the market capitalization of the Indian share market has surged remarkably, making it the 5th largest market in the world, which is something all of us need to be proud of. After enduring a high turbulent global environment in fiscal year 23, global stock markets recovered and performed well during fiscal year 24. The Indian stock market was among the best performing markets, with India's Nifty 50 index ascending by 26.8% during fiscal year 24 as against a negative 8.2% during fiscal year 23. Another key metric, the market cap to GDP ratio, paints an interesting picture. India's market capitalization to GDP ratio has improved significantly over the last 5 years to 124% in fiscal year 24 compared to 77% in fiscal year 19, far higher than that of other emerging markets like China and Brazil. The markets were supported by a surge in retail activity through direct and indirect channels. If you see on the chart, retail investors have taken the route of indirect channels, which basically includes mutual funds. SIPs, asset under management, contributions and the number of accounts have seen a steady increase over the last 3 years. And that's not it. The number of IPOs increased 66% to 272 IPOs in fiscal year 24. As per E&Y Global IPO Trends report, Indian exchanges were global leaders in IPO listings. Other notable improvements was the emergence of GIFT IFSC emerging as a dominant gateway for global capital inflows into India. Even technology has also played a crucial role in market development. India's unique digital architecture has moved towards a T+1 settlement regime and is soon shifting towards a T+0 or instant settlement. The banking sector acts as a lifeblood of an economy, channelizing savings into investments and facilitating financial transactions, fostering growth and stability. And India's banking sector have been underpinned by the ongoing improvements in asset quality, enhanced provisioning for bad loans, sustained capital adequacy, and a rise in profitability. Credit growth remains robust, especially in double digits, mainly driven by lending to services and personal loans. Additionally, there has been a considerable improvement in the asset quality of banks, led by improved borrower selection, more effective debt recovery, and heightened debt awareness among large borrowers. The gross non-performing assets ratio of scheduled commercial banks continued its downward trend, reaching a 12-year low of 2.8% at the end of March 2024 from its peak of 11.2% in fiscal year 18. Lastly, let's talk about the growth strategy. The survey emphasized the necessity of a new approach for New India. Moving forward, the government needs to focus on grassroots reforms and improving governance to ensure the structural changes of the past decade lead to strong, sustainable, balanced and inclusive growth. With several priorities at hand like job creation, addressing MSME bottlenecks, unlocking potential of agriculture sector, tackling inequality and so on, India can focus on these key areas in the short to medium term to yield a sustainable and balanced growth. For India's growth strategy during the Amrit Kal phase, 6 main areas are crucial: boosting private investment, prioritizing the growth of MSMEs, unlocking agriculture's growth potential by removing policy barriers, secure financing for the green transition, bridging the education and employment gap, and lastly, enhance state capacity to sustain and accelerate progress. Having said that, this is me, Ralison, signing off. Have a great day and stay safe. And now that we have the union budget to be unveiled tomorrow, let's keep our fingers crossed.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.